Why long-term care insurance? Real intent is to help you pay for care that extends beyond your ability or your comfort level to self-fund. I didn't say self-insure, I said self-fund. Perhaps you simply want to not drain your retirement nest egg by accelerating your expenses into long-term care. You want that third party paying a good portion of it. Then there's tax efficiency. If you're paying purely out of pocket, the first 7.5% of your adjusted gross income is not going to be a tax deduction. It's what you spend on eligible long-term care expenses that are beyond that you can deduct. Using long-term care insurance, you can reposition assets for tax-free benefit. You can reposition your assets for tax efficiency. Also, a long-term care insurance policy typically has what's called care coordination, a third party that helps you navigate the maze of options. When do you need to get a plan of care from a physician actually, that's what you need to get your claim started. What does that entail? Working on that, and then what are your options after you have it with regards to facilities and costs and all that sort of thing. So the care coordination can be a big deal. So the traditional long-term care insurance has been around the longest, hence the word traditional, and it usually has the most benefit for your premium dollar. And there's always exceptions to what I'm saying. Premiums could rise on a class basis. An insurance company is not allowed to raise any one individual's premiums. You have to do it through approval by a state department of insurance for a certain block of business that they can justify the excess costs to with regards to raising a premium, which, by the way, has to be justified as cost. There can be no profit involved, no compensation to an agent for raising in-force policy premiums. It's really there to keep the company solvent and able to pay claims. It can be a bummer, yes it can, but it'll usually have alternatives. For example, keeping your premium the same and having a lower benefit if that's what's necessary. Have an agent help you look at those. Traditional long-term care is use it or lose it as for your auto insurance. Only a traditional long-term care insurance policy can be a partnership plan. Not all traditional policies are partnership plans, but all partnership plans are traditional policies. What does partnership mean? The short of it is, if Medicaid is a strong possibility for supporting your need for long-term care, then you want to meet with an elder law estate planning attorney and also with a good agent with regards to long-term care insurance. And partnership plan could be really important in that planning because there's this thing called Medicaid recovery. Partnership plan and work with an elder law attorney who's experienced with Medicaid planning. Workplaces are offering traditional long-term care insurance more than they were, say, 2 years ago. And the beauty of a workplace policy is that when they first roll it out, they'll give you an open enrollment for that benefit that's guaranteed issue. No health questions, typically. So that can be huge. Now, if you let it go and you say, oh, I'll just get to it next open enrollment, sorry, you had your chance. They're not going to let you decide every year, like for your health insurance. If you're a business owner, there can be substantial tax advantages by offering workplace long-term care insurance. And depending how you're structured, there's associated benefits. An alternative to traditional long-term care insurance is asset-based long-term care insurance. It can be a life insurance or an annuity. And this is a way to reposition a portion of one's conservative allocations in their overall investment portfolio. And it can also be a way of repurposing say, a cash value life insurance policy that you didn't think you needed anymore. You're not sure what you're doing with it. Maybe you're not happy with it. Same thing, you might have an annuity that you're like, why did I get this? I'm not sure what I'm going to do with it. Maybe I don't need it. If you have the right kind of advisor look at this for you, you might be able to reposition that asset for a long-term care benefit that maybe what you had before was taxable, but now your benefit from your repositioned, your new insurance contract will not be taxable. Oh, if you're married, sometimes, whether it's traditional or asset-based, there could be a pooled benefit for the two of you. Another appealing feature of asset-based long-term care insurance is somebody gets benefits. Either you can get long-term care benefits while you live, or your heirs get a death benefit after you pass on. Choices can be on whether the benefit is a reimbursement or a cash indemnity. Reimbursements can get complicated. If you're not really sure who's going to be handling your finances and you're seriously considering long-term care insurance, you might want to go for a cash indemnity, because it's a lot easier to manage cash that once you qualify for it, once you qualify for a claim, you get the cash. Now, they're not going to pay as much out compared to a reimbursement limit, but the ease of administration is so much simpler. And you can then use the money however you want. You can use the money to pay informal caregivers. You can use it, to pay your daughter-in-law or your son or whoever's going to help you out. You can use it to pay for services. There are private care coordination services out there that a reimbursement policy would not pay for. Now, typically they're off of their own. But my point is, here you could pick your own care coordination type service if there's one in your area, and you would have the cash perhaps to pay for it, because there's no restrictions on the use of the cash once you qualify for it. Win number 13. Do you want other people's money to augment your ability to pay for long-term care? Yes or no?